Hey, what's up, everybody? It is Tuesday, April 18th. I gotta say, I was very impressed with the market's resilience today. And that's because in the last 2 days, we've seen the federal budget for April flip from a surplus to, from a deficit to a 70 billion surplus. And actually, if you look from the peak to where we are now, we had a peak deficit at the beginning of April of 55 billion, and now the government's running a 70 billion surplus. That's a 125 billion drain already. And today, with tax day, the number's going to be a lot higher. So 125 billion drain from the economy's financial balances. Probably today, we'll see the number tomorrow, but it'll be, we'll be probably up around a 200 billion drain. And the market held in there. I was very surprised. I don't expect it to continue like that. It just seems a little hard for me to imagine that when you get these tax drains of this magnitude, and this is the big one, this April, and then there's a quarterly tax quarterly tax payment in June. Last year, all totaled, it was 430 billion, and it took from mid-April until like mid-August for all of that to be recovered. So that was a 4-month period. I'm not saying it's going to be 4 months now, because now we have a situation where we have these massive interest income transfers because of the Fed's rate hikes. It's funny because again, that's never it's never spoken about that way. It's always spoken about high interest rates, and it's going to cause a recession and this and that. And we still have the debt ceiling situation to deal with. But just consider the fact that since April 1st until yesterday, we've seen already a 125 billion drain from the economy's financial balances. And like I said, once we get today's numbers, which we'll see tomorrow, I'm sure we'll be up over a 200 billion net drain. So that's impactful. That hurts. That just leaves a lot less buying power out there, and it takes time. This is not something like that I just kind of made up in my head, this is just based on pure numbers. You have these flows, they're very predictable. We know when quarterly tax payments hit. We know when the big April tax payments hit. We know when quarterly interest payments, come into the economy. So, these flows, they're totally tradable, and they're totally, you could totally anticipate when they're going to happen. We know when they're going to happen. And ordinarily, we know the market's reaction. It's just a matter of, it's like the tides coming in and going out. When the tide's coming in, raises up the water level. And when the tide's going out, just, water level goes down. It's not so hard to understand. But today's resilience in the face of this, I was pretty impressed. So I don't know if I should say right now, it might be a little bit too early to say that was a good sign, but it was a good sign. And we'll see what happens over the course of the next few weeks at least, because this is going to continue. This is not just, it's not over today. It's going to linger. And then again, we get something coming up in June. And by the way, June is when the whole debt ceiling situation has to either be resolved or, that's it. We go basically into kind of like an austerity situation. I've been saying, and I've been saying all along, I don't think that's going to happen. I think now it looks like they're going to come up with some kind of bipartisan compromise where we get some cuts here and maybe some tax increases there, which will negatively impact at least one aspect of the fiscal picture. But again, we have these interest income flows, and they're just going to keep going. I mean, this is something, I talk to you guys about every single day, that we're still just in the early stages of this, because we're only 1 year into when the Fed started raising interest rates. And so as these as these securities mature, 2-year, 5-year, 10-year, as they mature at a higher coupon, more interest income is transferred. So it's a positive thing. But I just want you to be aware that today's market action was pretty good, I have to say, because I thought we'd be down a lot, more than we were. We actually hardly were down at all, just a little bit. And we've already seen a pretty significant, in the last 2 days, just a flip from, we had a small surplus, small deficit, I believe on last Thursday. And then from Friday to Monday, we went from a 20 billion deficit to a 70 billion surplus for the government. Remember what that means. When the government runs a surplus, whatever that surplus is, 70 billion, that's 70 billion that it took away, that it drained away from the non-government or the economy's financial balances. So, that's why taxes hurt. I don't have to, the easiest way for me to explain it is not to explain it at all. It's just to say that, it sucks to pay taxes. Nobody likes to write that check. And you see the balances in your account go down. That hurts. It's hard to take. So it's something that everybody understands, and it does have an impact on the market. But again, I'll just say that today, I was impressed. I thought we'd be down more. I still have a feeling that the short term is negative, because we're going to continue to have a drain, and the market is, don't forget also, in 15 days or so, the Fed's going to raise interest rates again. And, we got to go through that in May. But that's it for today. Not a lot to talk about other than the fact that the market held up pretty well in the face of, the reversal in the fortunes of the non-government. And that's a pretty good sign. Let's hope it stays that way. It's encouraging anyway. That's it, everybody. Talk to you tomorrow. Bye.